morning.
Right.
Welcome to the investment meeting of the Teachers Retirement Board for May 8th, 2025. I'll start by calling the roll. Brian Berge, well, I'm sorry, it's Kevin Wu.
Kevin Lee for Mayor Adams, present.
Thomas Brown,
Present, Patricia. Good morning.
Gregory Faulkner, John Dorset,
John Dorset, designee for control Bradland.
Victoria Lee,
Good morning, present.
Christina McGrath.
Good morning, Patricia, present.
We had a quorum, so I'm going to chair.
Thank you, Patricia. Good morning, everybody. Good morning. Good morning, John. And we'll begin with Passport Funds March 2025 performance review, and that's Goldman Sachs. Michael?
Thank you.
Thank you.
Chair. Good morning, everyone.
Good morning.
Gina's going to share her screen. And I will talk through some of the numbers here. I'm going to focus a little bit more so on the first quarter as a whole, which I know we did chat a little bit about in terms of market performance last month, but we'll dive a little bit deeper into some of the numbers as it relates specifically to the Passport Fund. So the Diversified Equity Fund ended the quarter with about $18.2 billion in assets. The fund itself was down just over 3%, a little bit behind its benchmarks for the quarter. It was a challenging period for active management, both in U.S. and non-U.S. markets within the portfolio. We saw the U.S. equities during the quarter down about 4.95%, so just shy of 5%. On the flip side of that, international equity markets, as measured by the International Composite Benchmark, we're up over 5%. So we've definitely seen, as we've been talking about, divergence between U.S. and non-U.S. equity markets to start the year. Not surprising given all that's going on in both the political and market backdrop that we've talked about as well. And so far, calendar year to date, as I noted before, that fund is down about 3%. On the flip side of that, the balanced fund with about $640 million in assets, you can see that was up about 1%. That fund, you'll recall, is comprised of both global equities, but also short duration or short-term fixed income, high-quality U.S. investment-grade fixed income instruments. As yields came down in the first quarter, that was a bolstered, if you will, the performance of that fund. The International Equity Fund, which is structured to align with the International Composite of the Diversified Equity Fund, that had a positive return of about 3.2%. As I noted, with some of the challenges of active management in that quarter, that fund did lag the 5% return of the benchmark. And the Sustainable Equity Fund, which you'll recall, is comprised of a U.S.-oriented large cap growth strategy. That fund was down about 10% for the first quarter, in line with the market during that time period. It was a very challenging period, especially for some of those high-flying growth companies that we had seen do quite well in the U.S. over the last 3 years. They were very much out of favor in the first quarter. And then you can see finally returns and assets for the U.S. equity and international equity index funds, which were, as you'd expect, aligned with their benchmarks. The U.S. fund down about 4.8%. And the International Equity Index Fund up about 5.4%. So I'll just pause there and see if there's any questions.
Any questions from Mike? Thank you.
Great. So we will switch over to the month of April, which was a long year in and of itself. I know we met, I think it was close to the middle of April when we were in the thick of the roller coaster ride that the markets were going on during the month. It was an interesting month, not only for all of the policy news coming out of Washington and how really the global market community was reacting, both in terms of differing political perspectives from many countries, but also in terms of what we were hearing with respect to trade and how many in the economy had gone from having pretty constructive views. Many market participants had gone from having pretty constructive views on the U.S. economy coming into 2025, and how quickly we saw many take a pause on those constructive views in the middle of April as we started hearing more uncertainty around policy positions coming out of Washington. So if you think about what we talked about at the beginning of this year, very much a focus on the resilience of the US economy, the strength of earnings and balance sheets coming into 2025. In many ways, the strength of US balance sheets have not changed. We just wrapped up or close to wrapping up what was a pretty positive earnings cycle for US companies. And in spite of all that, we're seeing such significant market volatility, really driven by, as we talked about before, uncertainty. And I would say in many cases, an unwillingness for companies to provide guidance in such uncertain times. It's very difficult for many to plan around capital expenditures. There's two sides to that. We did hear in Meta's earnings announcement that they are going to move forward with continuing CapEx focused on AI. They do think that that's the future. But many companies who, even though they had strong earnings announcements in the last few weeks, have paused on providing guidance for the year because of that uncertainty. We call that uncertainty generally when we're hearing about it soft economic data. There's also the consumer side of that, where in April we were seeing pretty significant softening to that soft economic data from the consumer side as well. And the converse to that is on the what we call hard economic data, which for the US has continued to look resilient. So we have seen inflation actually come down very slightly in the US to start the year. Growth has not really started to change materially or slow significantly. And labor prints in the last few weeks have continued to also be somewhat resilient. I think if we start to see some of the hard economic data turn over the next few months, that'll certainly be reason for concern. At this point, I think the concern really more so is just around increased uncertainty and market volatility and feeling confident in your ability to sort of manage through that. So with all of that and all of the craziness of the month of April, the US equity market was down just shy of 0.5%. So about 2/3%. International equity markets were up about 3.75%. So again, we've continued to see divergence among equity markets, but showing some resolve in terms of how markets rounded out the month. I'll pause there and see if there's any questions. There's a whole host of numbers on the market benchmarks here, but you can see across the board pretty strong, or I should say at least positive numbers in all cases except for with respect to the US equity index fund, which had a negative return of about -0.7%.
Thank you, Michael. Any questions, Michael? Goldman Sachs. Thank you. Before we move on, Patricia, let the record show that Anthony Giordano is now present. Thank you. Thank you. And we move on. Any questions for Michael? Now any market commentary in the pension fund for public agenda? Steve.
Great. Thank you, Mr. Chair. Good morning, trustees.
Good morning, Steve.
I know Wilfredo's waiting back at the ranch. Great. Thanks, Wilfredo. One more slide, please. Just Mike hit the nail on the head. Sometimes I even wonder why I come to these meetings because Mike does such a great job of the market updates, but uncertainty is the buzzword. So we added just a couple of headlines that we thought were noteworthy. That really came out during the month of April. Up top, you can see tariffs, inflation, and market uncertainty. Again, it's really having an impact on consumer sentiment, consumer confidence, business sentiment, business confidence, and investor sentiment and investor confidence. To Mike's point, though, we really haven't seen a lot of that show up in the hard data because consumers actually were doing a lot of front running in expectation of higher inflation. They were buying things earlier, expecting that the tariffs would have a negative impact on the price of those goods. We also saw during the month of April, gold traded at one point over $3,500 per troy ounce. It's about $33.45 this morning, so it's come off a little bit. But again, another example of a flight to quality and a flight away from, say, the US dollar. We can talk a little bit more. And then the last point on the lower left-hand side, the dollar keeps falling and it's losing somewhat of its luster as a safe haven asset. year to date, the US dollar is off a little, almost 9% versus say the euro. And as a general matter, it's down across the board against other currencies. Some of this has to do with the increased fear of recession in the States. Also has to do with a little bit of flight away from US dollar assets, which we continue to monitor and look at. On the next slide, just a quick look at those. These are familiar charts on the upper left-hand side. You can see inflation measures and GDP growth. To Mike's point, we really haven't seen a dramatic impact. Now, we did see the growth come down in the first quarter from 2.5% at the end of last year to just 2%. That's the early estimate of first quarter GDP growth. That's still trend, which means the long-term average growth for the US economy is about 2%. China continues to hold in there about 5%. More importantly, I think for today is the UK. Their growth has slowed quite significantly. They're forecasting a 1% growth. They actually cut interest rates 25 basis points this morning. And China actually cut rates 10 basis points yesterday to spur some economic growth. Also to address some of the concerns that economy has and will continue to have relative to tariffs. On the lower portion of the left-hand side, you can see inflation still pretty strongly above the central bank 2% target. 2.4% in the States. I think core PCE was up over 3%. So a little bit of inflationary pressures there. But as a general matter, inflation still is an issue and a challenge for many of the central banks around the world. Again, echoing Mike's point on hard data on the upper right-hand side, unemployment still 4.2% unchanged from the prior month. The average of the last 3 months non-farm payrolls adjusted for revisions is about 155,000 jobs created per month. That's actually quite strong and pretty constructive for the U.S. economy. And lastly, world currencies, as I mentioned, all that green is a reflection of, say, the euro appreciating in the 1 month space 3.7% versus the US dollar. So again, a flight away from US dollar assets. I'd also ask you just to look at the euro number at 3 months. The euro is appreciated relative to the dollar by 8.8%. I'm going to go through a slide in a minute that will look at the German DAX index. And you'll be able to see the local market return versus your return that includes this 8.8% or actually 10% in currency appreciation as well. On the next slide, as I mentioned, rates have been fairly, I can't really say they've been stable. China cut 10 basis points yesterday. The Fed remained on hold since its last interest rate reduction in December of last year. Given all the uncertainty, the Fed needs to be patient and vigilant against inflationary pressures as well as the declining growth. Again, they have a dual mandate to focus on full employment and stable pricing, and stable price levels. So again, they're continuing to monitor the situation as the impact of potential tariffs and actual tariffs kind of work their way through not just the soft data, but the hard data as well. Below that, you can see a graph. I asked you to look at just 2 lines here. The red one is the most recent from the 5th of May. And the one below that in gray is from the end of 2021. And this basically says if you look in the 2-year sector, the 2-year treasury yields are about 290 basis points above where they were a few years back. And that just basically means you're getting more income from your fixed income. On the upper right-hand side, a look at credit spreads. They have widened for the year, but they have tightened a little bit. So investment grade credit spreads up top, measured by the Bloomberg US Ag corporate average option adjusted spread is a fancy way of saying it, is 102 basis points. That's actually in about 10 basis points from the prior month. And in high yield, those credit spreads have actually widened out as high as 470, I believe was the high mark, maybe a little higher than that. And it's come in nicely since the last time we spoke. It's in about 60 basis points, again, increasing the price of those assets.
Steve, I just have one thing. And maybe this is just for the next time. In the change column where it's negative green 1%, could you do red for negative and the green for positive? Because it's kind of confusing. Just
Well,
aesthetically, I'm just pointing that out.
one talks, yeah.
You see my point? I'm just, red and green.
Spreads have come in.
Yeah, but you see it's -1 and it's
Well,
I'd like to
spread-
see more green though.
Yeah,
I think that's what I'm hearing.
That's fine, that's fine. Just a critique as I'm seeing it
We'll
now.
pretty it up. I'll run that by Dan.
Because negative, I think of in red, and not.
Yeah.
just-
Well, it's a
just
declining
throwing that.
spread.
Yeah, I'm just making the point. I'm a common man.
Yeah, yes, you are. Below that, reference rates, moving on, you can see, 2-year treasuries at 384, 10s at 435, they're at 430 today. They started the year, if you remember, at 458. In the middle part of April, they traded as low as 385 in yield. Again, so there's a lot of volatility there, and Mike talked about that, and I'll talk about that a little bit more in a moment. On the next slide, just a quick look at where we are. Again, equity indices on your left-hand side and bond market 10-year or sovereign yields year to date. You can see there's a little bit of red up top on the left-hand side. That's the industrial, Dow Jones Industrials, the S&P 500, and the Nasdaq Composite, all in red for year to date. But actually, they were much further down earlier on in April. So the recovery has been pretty substantial. I'd say the other point I would make is look at line number 24, the DAX, the DAX, where it actually shows, and I can indicate this on the slide. This is the only thing that's really noteworthy is the DAX, the German stock index is up 17% in year to date in local currency terms. But when you convert those back to US dollars, and we're a US dollar investor, it's fully a 28.16% return. So that's the benefit of having a weaker dollar when you hold non-US assets. The other thing, as I said, that I take off of this is I look at where Treasury yields are. This is 10-year US Treasury yield, 435-ish at the last print, about where it's been on average for the year. And again, it's traded as high as 479. And as I mentioned, closing at 399, but traded as low as 385 intraday at the peak of disruption in April. Moving on to the next slide, just look at volatility, and I think Mike covered this well, but just a couple measures. This is a look at two volatility measures. In red on the right-hand scale is the VIX, that's also known as the fear index. This is the options market expectation, VIX. It's the options market expectation for volatility over the next 30 days. It's actually come down substantially, but it was as high as 55, 54-ish. The all-time high of the VIX was October 24, 2008 at 89, to provide some context. So volatility has come off again as the markets had a chance to digest the impact of tariffs, potential impact of tariffs, and some of the rhetoric around that. But it is, as I said, still somewhat elevated, even though it's at 24 relative to where it's been more recent. You can see the red line. On the left-hand scale, that's the MOVE index. That's the Merrill Lynch Options Volatility Index. It's also known as the VIX for bonds. Again, a fear index. And again, looking at levels at their peak at between 120 and 140. That shows an elevated stress level in the fixed income markets and U.S. Treasuries in particular. And lastly, on the next slide, just to look at performance, your performance actually through the end of the first quarter, March 31st, 2025. A little bit of red in there. As I hate to tell you, obviously April was more challenging, but you can see where we are. Again, as long-term investors, we should focus always on long-term results. 10 years out, and you can look at the strong performance of U.S. equities, private equity, infrastructure, and fixed income. It's struggled a little bit with the low levels of rates and the backup yields that we've seen. And with that, I'll open up to any questions.
Thank you, Steve. Any questions for Steve? Thank you. Well done. Great. I think that concludes our business in public session. Do I hear a motion to go into executive session?
So moved.
It's been moved. Is there a second? Second. Thank you, John. Any questions, concerns? Great. All those in favor of going into executive session, please say aye. Aye. Those opposed say nay. Abstentions? Now in public, now in executive session. Thank you. We are back into public session and Liz will tell us when we're ready to go.
Mr. Chair, do you want me to invite your gentleman?
Oh, yeah, thank you, thank you. Welcome back to public session and I personally welcome back our Michael Livio from Goldman Sachs. I believe at this time, we're going to have a readout of what we discussed in executive session.
You bet. Thank you, Mr. Chair. Hello, everyone, by the way.
Hey, Priscilla, how are you?
How are you?
Fine.
In the executive session of the Passport Fund, there was a manager update. There was a presentation on a service provider. Consensus was reached. In the executive session of the Pension Fund, there was an update on preliminary performance. There were 2 portfolio construction updates. There was an alternative credit presentation. Consensus was reached. There were 2 private equity presentations. Consensus was reached on both. There was a real estate presentation. The matter was tabled. There was a manager update and public equity presentation. Consensus was reached. The meeting concluded with a discussion on a contracting matter. Details to be made available at an appropriate time.
Oh, Priscilla, thank you so much. Well done.
Thank you.
Are there any questions for Priscilla? I think that concludes our agenda public session. Oh, you have a question, Priscilla? Or you just?
No, that was.
Oh, you're waving goodbye. Okay. Wait, we'll wave goodbye when we adjourn. Do I have a motion to adjourn?
So moved.
Second. It's been moved and it's been seconded. Thank you, Christine, and thank you, John. Any discussion? All those in favor of adjourning, please say aye. Those opposed say nay. Any abstentions? This meeting is now adjourned. Thank you, everybody. Thanks, Priscilla.
Thank you.
Thank you, everybody.
I don't know.
Oh,